This is about private credit. And if you guys don't know what private credit, I'll explain what it is real quick. So it's basically credit outside of the traditional banking system. So there's all these debt funds and all these folks that, as you guys all know, lended on multifamily. All these traditional names now are in trouble. And where do they get their money? They get their money from insurance companies and companies like BlackRock. So they get their money from institutional investors. So you set up, for example, ABC debt fund. You go to BlackRock, you get $100 million, $250 million, whatever it is, and then you start on the street. So that's what this is. And so, Jerry, why don't you first pop up that first graphic? I think it's important that we show the rise in private credit. So this is a really important graph. So basically what this means, now this is not 2008. I want to point that out, guys. But this is what's going on behind the scenes. This is big money, Wall Street money investing into private credit. So the way you need to think about this is, if a bank, let's say, think of it like airplanes, like a bank would invest in, like, let's say the big airlines. Private credit invests in jets, private jets. That's the way you need to think about this. So private jets are expensive. They're flexible. They don't do what banks do. So there's a little more leniency. But BlackRock, on the other hand, they are the largest asset manager in the world. Okay, that's good, Jerry. Thank you. BlackRock's the largest asset manager in the world. And so why is this important? I think it's important because they're traditionally not this early. And so all it really does is it's just exposing things that we kind of all thought were there. Because these debt funds, what they've been doing is they've been putting these assets on their asset management balance sheet, kind of with a hope note, you know what I mean? Working with borrowers, so all these properties are sitting there. All these multifamily properties are sitting there, and so for BlackRock to come out and report this, and just to be clear, this is a big deal, right? I mean, BlackRock is obviously one of the most conservative and largest money managers in the world, if not the biggest. And for them to come out and write this down, it basically shows that there is a problem inside the engine. And as before, we all kind of knew it, but we were just waiting for the first domino. This is a big domino.
Yeah, I mean, essentially, they were really thinking rates were going to go down, right, and save all of this, and that's what they were waiting for. Extend and pretend was kind of pretending everything was okay, while at the same time, thinking that the rates would go down and it would be okay. And to your point, they weren't, recording these on their balance sheet. They were recording them as if everything was okay.
Yeah, and to be clear, BlackRock, it'd be like BlackRock would lend, or any of these big institutions would lend to, somebody, and then they would create this debt fund. So, so really, it's BlackRock invested in another company that actually placed money out on the street. So that's why this is so important. And so this is basically when cash flow ends, the math it becomes a reality, and that's essentially where we are. And so Jerry, let's look at
quick before you say that. I remember we were at dinner about a year ago, and you had said, you guys were talking, and you said, they're raising money. Money without the investors knowing these assets are in trouble because they're writing them as fine on the balance sheet. So it was a little bit of sketchiness.
Okay. So the entire industry in 2001, 2, 3 was based on values going up, rates not jumping like they did, and the deal working. So it's all based on some kind of future refi, right? I mean, that's what was happening prior to this. So let me just explain it in simple terms. Let's say there was a 300-unit project that somebody paid $200,000 a unit, or $60 million. So that $60 million, let's say 40 was debt, 20 was equity. Okay, so a traditional deal, they move forward. So year one, what happens? I'm going back to, let's say, 2022. Year one, rates start to go up. Cash flow goes down. All things being equal, property's still moving along just fine.